Welcome to this explainer. Today, we're going to dive right into how complex data aggregation in mortgage lending can actually hide some massive compliance risks. I'm really excited to guide you through this because we're looking at a completely crucial intersection of data, risk management, and fairness in housing. Listen, as a mortgage professional, your blind spots are literally your biggest liabilities. Today, we're unpacking how the very tools that are meant to streamline your loan terms might actually be working against you. The mortgage finance industry relies so heavily on aggregating vast amounts of data, right? But algorithms can easily turn things like zip codes or schooling data into hidden proxies for race. And if we aren't careful, all that complexity can obscure some really serious issues. So here's our roadmap for today. 1. The data bias trap. 2. The cost of discrimination. 3. Tracking borrower demographics. 4. Measuring financial fallout. 5. Enforcing fair lending policies. And finally, 6. Building a fair future. Let's get into it. Section 1. The data bias trap. How complex aggregation creates blind spots. The mortgage finance industry uses massive data aggregation to figure out the exact terms and conditions of a loan. We're talking about really critical provisions here: the size of the mortgage loan, the interest rate, even upfront discount points and other fees. But here's the catch. This highly complex process can easily result in discriminatory lending practices. And it honestly doesn't matter if that bias is intentional or completely unintentional, like an algorithm quietly using a zip code or an education level as a hidden proxy for race. The regulatory consequences remain exactly the same. An algorithm might be quietly factoring in variables that inadvertently penalize certain demographics. And if you aren't actively looking for it, you just won't see it until the regulators come knocking. To really understand this risk, we need to be incredibly precise about what we're talking about. The SASB standard defines discriminatory mortgage origination explicitly. It defines it as discrimination on the basis of race, color, religion, national origin, sex, marital status, or age. But crucially, it also includes discrimination that happens simply because all or part of an applicant's income comes from public assistance. Making absolutely sure your automated systems and origination processes aren't tripping over these specific criteria is essential, because at the end of the day, good intentions simply do not prevent regulatory violations. Moving on to Section 2, the cost of discrimination. Regulatory fines, mispricing, and reputation. Failing to monitor your data aggregation leads directly to 3 massive hits. First up, you face severe regulatory fines and legal settlements for violating fair lending laws. Second, there's a huge increase in reputational risk. News of discriminatory practices can destroy your institutional trust practically overnight. And third, and this is a really big one for your bottom line, it leads to negative financial performance because of loan mispricing. Think about it. If your data is biased, your pricing is wrong. You're fundamentally destroying shareholder value while actively harming consumers. Section 3, tracking borrower demographics. This covers SASB metric FN-MF 270.1. Now, if you're going to track lending to minority borrowers, you need a bulletproof definition of what a minority actually is, right? To ensure global compliance and undeniable authority, the SASB standard grounds its definition directly in a gold standard framework from the United Nations Office of the High Commissioner for Human Rights. It defines a minority as any group of persons constituting less than half of the population in a state, sharing common characteristics of culture, religion, or language. And it explicitly notes that a person can belong to these groups freely without needing citizenship or official recognition. Utilizing this definition gives institutions a really solid, standardized baseline to work from, anywhere in the world. Using that UN definition, you've got to categorize your mortgage portfolio into 2 distinct buckets: minority borrowers and all other borrowers. This applies to both first lien and junior lien single-family residential mortgages, which includes home equity lines of credit and home equity loans. So if an applicant is of one or more race or ethnicity, or if there's more than one applicant and the primary co-applicant is a minority, that mortgage gets categorized as minority. Also, for entities operating globally, you have to categorize applicants based on the jurisdiction where they applied for the loan. That's a really crucial operational detail for multinational firms navigating different regional demographics. Your reporting should provide a totally transparent view of the absolute number of loans, their total value, and the weighted average loan-to-value ratio split right down the middle between minority borrowers and all other borrowers. By weighting the loan-to-value ratio by the respective loan amount, you get a highly accurate, clear picture of the risk and lending patterns across different demographics in your portfolio. Section 4. Measuring financial fallout. Let's look at SASB metric FNM MF 270B.2. This specific metric requires you to disclose the total amount of monetary losses incurred during the reporting period from any legal proceedings associated with actual or alleged discriminatory mortgage lending. We're talking about adjudicative proceedings involving your entity, whether that's before a court, a regulator, an arbitrator, or otherwise. Keep in mind, even an accusation carries reporting weight here. This metric forces total transparency, exposing the true hard cost of discriminatory practices straight to your investors. So what exactly counts as a loss here? Well, you must report all monetary liabilities to opposing parties or others. This includes civil judgments and settlements, regulatory penalties, disgorgement, restitution, and even criminal judgments. The only thing excluded? Your own legal and defense fees. But it absolutely doesn't stop at just reporting a number. The standard explicitly requires you to briefly describe the nature and context of these losses. Was it a settlement, a guilty plea, an issue with fraud, or maybe a problem with employee compensation? And most importantly, you have to describe the specific corrective actions your firm has implemented in response to these legal proceedings. Section 5, Enforcing Fair Lending Policies. Here is SASB metric FMMF 270B3. To actually reduce the risk of unintended discriminatory lending, the standard highlights specific internal controls you must describe. First up, you need to ensure adequate training across your entire staff pipeline. This means your originators, your processors, your underwriters, and even your collection staff must all be comprehensively trained on fair lending policies. Next, you have to maintain rigorous, adequate documentation and record keeping. If you don't have the paper trail proving your processes are fair and consistently applied, you simply cannot defend your practices against regulatory scrutiny. It's as simple as that. You also need to describe your procedures for proactively monitoring your loan portfolio based on race, gender, ethnicity, and other critical factors. You can't just set an algorithm and forget it. Continuous portfolio monitoring is absolutely your best defense. Finally, you must provide clear disclosures to borrowers. Transparency with the consumer regarding the terms, interest rates, and fees like discount points is essential for ensuring comparable and fair lending conditions across the board. And our final section, 6, Building a Fairer Future. Proactive risk management in mortgage finance. Using the SASB mortgage finance standard isn't just about checking a box to satisfy a regulator. It's a strategic imperative. By rigorously implementing these standards, tracking demographics, disclosing losses transparently, and enforcing really robust internal policies, you're doing two crucial things. You are protecting your portfolio's long-term value from severe financial and reputational hits, and you're playing a vital role in ensuring fair, unbiased access to housing for everyone. I want to leave you with this final provocative thought today. Look closely at your systems. Are you actively managing your data to ensure fair lending, or is the sheer complexity of your data aggregation quietly managing your risk for you? Take a hard look at your internal processes today, because what you don't know about your lending data can, and for sure will, cost you. Thank you so much for joining me for this explainer.